Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another podcast with Carl Coolidge. Today we are going to dive into 401ks. So we're going to take 401ks in two different ways here. We're going to talk about what it's like to be a plan participant, which is the majority of people are going to be listening to this podcast. But we also thought it would be good to talk about some of the things that businesses have to consider when it comes to a 401k. So even if you're not a business owner with a 401k, it is important to understand that as a plan participant, some of the considerations that your business had to make in order to just put the 401k in place. So Carl, welcome to the show.
Thanks, Matt. Always great to be here.
All right, brother. Well, we're going to dive in with just a really open-ended question. And let's talk about the history of 401ks. Where did it come from? When did it start? And why did it start?
Well, great question. It was originally thought of in the early 70s. And believe it or not, a group from Kodak, if everybody remembers that name, came to Congress and said, we want to find a way to invest some money on a pre-tax basis. So Congress then began that process. And then I think it was 1978 when actually it was put into revenue code under the number 401k, which is why it's called a 401k today. So it was still pretty obscure at that point. Not a lot of people knew about it. And then in around 1980, a guy who was a benefit consultant and actually an attorney named Ted Benna really introduced the first 401k. He took it to a company that he was working with, and they began to implement it at that time. And then it sort of took off from there going forward.
And boy, howdy, has it has it really kind of turned on. And this is pervasive in pretty much everywhere.
Yeah, it's probably the biggest saving tool for retirement out there. There's nothing that's more utilized than 401k or retirement plans in general that I'm aware of.
Yeah. So how does it work? How does a 401k work? You're talking about pre-tax. Break down some of the nuts and bolts of this for us, please.
Well, basically, how a plan works is once it's set up by the employer, and it has to be what they call an employer-sponsored plan. So an employer has to initiate having the plan in place. But once it's structured, and again, I won't get into the structure details because there's a lot of different ways you can do that. But once you have it structured, then participants or employees, which is kind of an interchangeable name, will be able to participate in the plan by deferring money out of their paycheck on a pre-tax basis. So I use the example a lot. If you make $100, you decide you want to put $10 into the 401k, then the taxes that are remaining, whatever that may be for a person, come out of your paycheck. So it's truly a pre-tax deferral before anything else comes out of your check. So people really like that because it forces savings. It's money that goes into the retirement plan before they even see it. And that's why I think it's caught on so much over the years and why it's such a big benefit to employers. But that's the basic gist of how it works, is that you defer money, and there's been evolutions where they do Roth 401k now, which is the same concept. Money's deferred out of your paycheck, but it's done on a post-tax basis versus pre-tax. So that was an evolution that occurred probably a decade ago. It may be a little longer, a little shorter than that, but that sounds about right. So that's the basics of how it operates.
So the money comes out of my paycheck pre-tax.
Correct.
But I have to pay taxes on it. When do I pay taxes on it? And when am I able to take distributions on this 401k?
So the money is deferred. That's hence the word tax deferred vehicle. meaning exactly what you said. You get a tax deduction initially, then the money is deferred until the magic number that the IRS came up with was age 59 and a half. So once you reach age 59 and a half, then there is accessibility to the money, again, depending on different parameters of a plan. But typically you have to be retired or no longer working at a company before you can begin to take distributions after age 59 and a half. So the money is money that you never pay taxes on up until the point when you withdraw it. Because remember, it came out of your check on a pre-tax basis. It grew tax deferred over that time frame. And now when you take it out, you pay tax at ordinary income level of what you pull out of the account. And most people obviously do that in the form of some sort of monthly income.
Mm-hmm.
They typically don't take a lump sum because it would all become taxable at that point. So it's usually done on a monthly income.
Okay, that's a really interesting point. So am I paying taxes immediately at 59 and a half on the gains that happen within my 401k, or just taxes from an ordinary income perspective on what I'm withdrawing at the time of withdrawal?
Well, you will eventually pay tax on the entire amount as you withdraw, because remember, you're not just paying on the gains because it's money you never paid tax on.
Gotcha.
Because it was always deferred out of your paycheck. So to answer the question, yes, you would pay, as you withdraw that money, you pay ordinary income tax on it. If you elected to withdraw all of the money, then you would pay ordinary income tax on that sum of money. That's why most people take it as an income stream or over some time frame, so they don't have that large tax hit all at one time.
Gotcha. All right, let's switch gears just a little bit and get off the technical into the practical. How much should I put into my 401k?
As much as you can.
Nice.
That's the easy answer. Obviously, you have to get back to what can people do from an economic, a budgeting, cash flow standpoint. Everyone has bills, everyone has commitments, but you want to take advantage as much as you can, because one thing that we stress to a lot of participants when we're talking to them is you can't get back time. So investing, especially if you look at what's going on now in the world with all this volatility in the market, you never know when is going to be a good market or when it's going to be a bad market. But what has been proven is the longer you invest, the more likely you are to have a positive outcome, because you can weather ups and downs of the market typically. So we really focus on talking about the time that you need to be in the market. So I think that's a big, big part of the investing. And what you need to put in just really varies by person. If you start when you're very young, obviously you can put a smaller percentage because you have a much longer time frame. If you don't start until you're in your 40s or 50s, typically you're going to need to put a lot more money because you waited and you lost those years that your money could be working for you. But the limits for this year are someone who is under age 50, you can put in up to $19,500. And the IRS typically tweaks these numbers every year or every couple of years, where they increase the amount that the participants can defer. And then if you're age 50 or older, you can also add another $6,500 this year, which is called a catch-up contribution, and not ketchup and mustard, but catch-up contribution.
All right.
And so you could put up to $26,000 this year if you were age 50 or older. Again, the gross tax deferred, done pre-tax, and then you pay tax on it when you withdraw it after age 59.
Gotcha. Now, there's another word that we hear often, which is a match. Where does that come from? Does everybody have a match, and how does that work?
So the match is done from the employer side, and not every plan has a match, or it's not required to have a match. Generally speaking, you will see where employers do some sort of matching to make it a little more appealing to participants, where they feel like if they put in money, they're going to get some sort of contribution from the employer. there's all types of matching contributions, meaning different levels. A lot of people will see or hear where you get 50 cents on the dollar up to 6% of pay if you defer it. So in essence, if you defer 6%, you're going to get another 3% from the company. And then matching has, again, a lot of moving parts because there's a lot of different types of matches. But typically, when you have a match, it will be subject to some sort of vesting schedule. So again, just an example, and all plans work differently. But if we had this 50 cents on the dollar match that I mentioned, it may have a 3-year vesting schedule, which means from your date of employment or date of hire, you have to work for 3 years before the money that the company has contributed is yours to keep. So when you put in or defer money into a retirement plan, that money is always yours to keep. And what I mean by that is if you left and rolled the money over, or you stay there until you're 59 and a half and want to begin to take distributions, the money that you built up is your money. With the matching side, again, it can be subject to some sort of vesting schedule. And if you use the example of 3 years, they're saying the money will still show up in your account, but if you left prior to 3 years, you may not get all of that money, or you may only get a percentage of that money depending on how long you work for the company.
Gotcha.
So it's a way to sort of some handcuff, if you will, to have employees stay around to say, hey, if I'm going to make this contribution, I want to see that you're committed to our company. And again, as I referenced, there's a lot of different scenarios of how matching has changed over the years and what can be involved. And I don't want to dig too deep into that because that'll get more technical.
Okay.
But there is a lot of different scenarios. But in general, matching is just an employer contribution that's added to your account.
So I've got 2 more questions for you, Carl. What happens when I get a raise? Is there anything that you consult on plan participants when they do get a pay increase when it comes to their 401k?
We like to enroll participants at percentage levels. So some people operate when they look at their deferral of doing X dollars per paycheck. We always try to look at it from a percentage standpoint. So if we're meeting with someone and they want to begin deferring money, we get them to focus on do 3%, do 10%, 15%, because to your point, when they have those pay increases or pay raises, then they're automatically getting a bump up in that pay or that deferral that they're receiving. So it's a way to continue to defer more over time without necessarily having to increase your percentage.
Gotcha. Last question when it comes to being a plan participant is, what happens if I hit my limit annually?
From what respect?
Good follow-up question. So I've been able to, let's say I put 10% of my income into my 401k, but that 10% puts me over what I'm allowed to put into a 401k every single solitary year as per law. What happens with that overage? Does it not go in? Does it have to go somewhere else? Does that make more sense?
Yes. Thank you for clarifying. If you go over the limit, then it is refunded to you because there's a true up every year for plans to make sure that participants are getting the deferral amount they should, getting the matching they should. So there is a checks and balances to make sure those numbers are computing right. And if you do have an over contribution, it's refunded to you, but then it's included in your pay. So it's almost like it didn't happen, if you will. There are, again, with different matching versions and what they call safe harbor, where there can be ways that you don't see refunds and you're able to stop at limits. And a lot of payroll softwares now have where you hit the limits and they stop withholding it from your paycheck. So that world's gotten a little better over time also on being able to monitor that a little more.
Should I take that refund? I mean, I'm asking generally here, understand, and right, put that into a Roth 401k, or should I just throw a party?
Should always throw a party, Matt. That's a tough question because then certain rules come into play. So You can't put it into the Roth 401k because you can only defer up to the maximum limit in either a Roth 401k or a traditional. So you can't do, say, 19,500 in both. You've got to have it in one or the other. So the overage, that's not an option. Could you do an individual Roth IRA? Depends on your income, because there's income phase outs that may prevent you from doing that. But a lot of times that's maybe where you just invest the money over into just an individual account, one that's not tied to any sort of retirement plan.
Okay.
And that's a way to accomplish it because it's money you planned on deferring anyway. So we just have that individualized conversation with people if they have that issue. Doesn't come up a ton because obviously people need to save more in general. And so a lot of people aren't hitting that maximum level. Mm-hmm. But we do have those that do get there. And then we have that individual conversation on where can we go from here if they want to continue to save more dollars for retirement.
You know, I was thinking that we could spend a little time today talking about higher level business aspects of what it means to have a 401k. But I think I want to punt that to the next podcast because I have a couple other questions for you. Okay. You just used a whole bunch of words there when we were talking when we're talking about hitting a limit. It's vital that people understand that if you are a 401k plan participant, that you should still be having a meeting with a financial services professional. And you guys do something a little differently in the 401k plans that you manage and service. Do you have somebody that these people can talk to ask questions to?
Absolutely. I think, that's where we feel we are unique to a lot of other plan advisors, the way we operate, and that our process is very labor intensive. We do individual one-on-one education sessions with every employee. That may be done by a phone, that may be done most likely in person, it may be done by a Zoom meeting. But our goal, we call it custodian to CEO, is that we want to be able to meet with every person so they have the same opportunity to ask those questions about what are mutual funds, what are investments, what do people put into their retirement plan, all of those questions that they want to have answers to that they don't really have anyone to ask. And we feel like we're able to really make an impact with those participants because they're able to spend the time with us one-on-one and ask those questions. And so that's really what we focus on, if you will, our value we bring to plans, because a lot of the other pieces have become commoditized, in my opinion. So this allows us to really make a difference with participants at every income level.
Gotcha. So is there anything I should have asked you about 401ks that in my limited knowledge of the subject I missed?
Well, with the recent Secure Act that came out, and I think we did a podcast not long ago on some of these things that have come up, but one item you will see, I think, that'll become a little more prevalent if you just watch the news and see information, will be on what they call MEPs, MEP plans, or multiple employer plans. There used to be rules that you had, in order to have a multiple employer plan, there had to be some sort of connection among the businesses, right? So you couldn't say, I'm a painter and I'm going to go work with a large executive company and we're going to have a plan together, because there was really no connection. But now they've opened that up and the language is becoming much more flexible, where a painter, a contractor, a law firm can all have the same plan if they want to. Again, the details haven't been finalized, so I'm a little concerned how, from a practical sense, that will work. But that's one thing you're going to see coming in the future. And the whole goal of why they passed that, they feel that will result in better pricing for plans, lower internal fees on the mutual funds and investments. So we'll see how that plays out. But that's the one thing I'd say that you may see news about that'll be coming in the next few years. But it's not something I suspect that'll be picked up quickly, because again, that world continues to change. And at the end of the day, you got to figure out how you're going to administer that from a vendor standpoint, meaning all of the various mutual fund families, how are they going to handle administering that, and how exactly does it work well between these various companies where coming together makes sense. And again, if you want the matching to be the same or different. So there's a lot of little details still to be worked out, but that's something I suspect that'll be popping up in the next few years.
Well, we will make sure from a podcast perspective that we keep our fingers on the pulse for that as things develop with a multi-employer plan piece. Since you guys do focus a lot on 401ks, we'll make sure that we put that in a podcast. So thanks for your time today, brother.
Thank you, Matt. Appreciate it.
If you have not subscribed to the podcast, make sure you do. Make sure that if you know anybody who needs education on a 401k, I don't know, like anybody in Gen X, Millennials, Gen Y, Gen Z, this is a perfect podcast for you to share with them because a lot of people don't understand the basics of 401ks and how important it is to start early and also to take advantage of your employee matches. So for Carl Coolidge, everybody at Jacobs Coolidge & Company, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs Coolidge & Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.